You need to know what kind of monthly budget you're going to be able to afford on this. You need to sit down and see, what are you comfortable paying every month? And then remember that even though you have that number that you'll be paying, that's not just it. You have taxes, you have insurance. All this is going to depend upon what the insurance rate is and how much of a down payment you put at the time. Now, that means that you really need to go talk to a qualified mortgage lender, which I know people, if you don't know anyone, I would be happy to give recommendations. So they are going to want to know, what does your monthly pay stub look like? What are your last 2 years of tax returns? What does your credit look like? And then they're going to want to see what they call proof of funds, which is that you actually have that money in the bank account for your down payment, or that you can actually afford this monthly payment. Well, based on that information, they're able to tell you what you basically can afford in a house based on your income, your credit score, and how much of a down payment you're going to put down, whether that's 3% or 20%, which you don't need 20% these days. The average home buyer puts down 5 to 7%. So you take all these numbers, they tell you how much of a house that you can afford, and then they give you what they call the pre-approval letter. And that means that they think that based on all this information that you've given them, that you will fully qualify for the loan when you purchase a house.